Hi everyone, I'm Jared Murmas with Mainstay Global. We're a private equity firm specializing in commercial real estate funds. We're headquartered here in Austin, Texas, and we also have offices in mainland China. We're doing a video series covering the basics of investing in commercial real estate. The first half of this series will feature 3 parts, and this is the first part of those 3, so thanks for joining us. We've had several investors ask us, what's the best type of commercial real estate to invest in? And as you can imagine, with that type of question that's open-ended like that, my answer is usually, well, it depends. Each different segment has its own associated level of risk. So this video, we're really just going to go into the basics and cover the different segments, the different types of commercial real estate. Most people divide commercial real estate into 6 segments, but I'm going to be different and divide it into 7. The first category in commercial real estate is multifamily. Here we're talking about apartments. You have different types of apartments. Your most typical type that you see all around the United States is called the garden style apartments. These are usually 1 to 3 stories high. And then as you go up in stories, you get to anywhere between 4 to 6 stories in height. Those are called walk-up apartments. As you get into urban areas, you have mid-rise, which is up to 8 floors, and then high-rise, which is 9 floors and up. Within multifamily, you also have senior housing and student housing. Multifamily is generally seen as one of the lower risk asset types in commercial real estate, provided you don't have an oversupply situation where developers have gone in and just overbuilt apartment complexes in a particular city. Our second property type in commercial real estate is hospitality, and here we're talking about hotels and motels. We'll start with the most fully featured hotel type and then work our way down the list. Beginning this list is the resort. This is the biggest, fanciest type of hotel located in vacation areas. Think Cancun or Orlando. These hotels are located on a large piece of property to accommodate a large amenity like a golf course or a water park. Down from that is the full-service hotel. These hotels feature their own restaurant, and they offer room service to the guests. Down from that is limited service hotels, which do not have the restaurant or room service. You also have extended stay hotels, which are basically limited service hotels, but each hotel room has its own kitchen in the hotel room, so the guests can stay and cook their own food. You also have budget type motels, and there think of Motel 6 or something along those lines, where each hotel room opens up to the outside. Some quick terminology with hotels. When they talk about flagged hotels, the flag just refers to the big, large national name brand that the hotel's under. Some difference in the way that hotels are operated and owned. Your larger resorts and full-service hotels, they'll be owned by one company but operated by another. So you'll have the developer that owns it, and then they'll sign some type of hotel management agreement with one of the big flags, like say Sheraton. So you'll have the developer owning it, and Sheraton will operate the day-to-day business of the hotel. Limited service hotels are usually a little bit different, where the owner will usually franchise the big name brand, the flag on the hotel, and oftentimes the owner will operate the hotel himself, or he'll get a third party, usually a company you've never heard of. It's just a third party company that just steps in, and all they do is operate limited service hotels. Our third segment in commercial real estate is industrial. Within industrial, we've got heavy manufacturing, which is a collection of buildings all with one single purpose, and that's to create parts. So that you can imagine heavy industrial compounds have a lot of huge heavy machinery associated with them. And because it's so specialized for one particular use, it makes it pretty difficult to repurpose these facilities if you have a tenant leave that building or sell it. Next in line, we've got light assembly, which is more shell type buildings, kind of like warehouses, where they take the parts from those heavy manufacturing plants and they assemble them. It's not quite as customized, so it makes it a little bit easier to repurpose. Next, we've got warehouses, just empty shell type buildings where they store goods to redistribute them later, either to stores or to the end users. Then we've also got flex industrial, which is a mix of usually warehouses in the back and office space in the front. And then a different type of flex industrial is known as R&D, which is basically flex industrial, but a little bit more specialized to the tenant. One of the biggest risks with industrial, if the company itself doesn't own the real estate itself, is that the landlord has only one tenant to depend on. So if that tenant goes out of business or decides to skip on their lease, you're stuck. The whole facility is empty and vacant, and it also often stays vacant for a long period of time. So it can be difficult to get your occupancy back up in those industrial types of facilities. Our fourth asset class in commercial real estate is retail. And here we're talking about malls, strip centers, restaurants, grocery, or mixed use, which will be a tall building with retail on the bottom and office space, or apartments or condos on top. Within a shopping center or shopping area, you can also have what's known as pad sites, which are standalone buildings. Think gas stations or standalone Starbucks or restaurants or something of those types. Within retail, what's really important with retail is traffic count and visibility. Those are of utmost importance to drive traffic and drive consumers to the shopping centers. So it's important that you have a really good anchor tenant there that'll have that kind of draw, so that all the smaller tenants can benefit from the traffic count of the larger anchor tenant. The leases in retail are a little bit unique in that most leases have a base rent plus some type of percentage of tenants' gross sales component. As far as risk level goes, retail can be highly affected by either the state or national economy. So when the economy is going bad, it does affect retail quite a bit. Our fifth asset class in commercial real estate is office. Office can be either skyscrapers all the way down to small office buildings. It's split into three different categories. Class A being the nicest, newest, nicest finish out, commanding the highest rents in the best areas of town. Class B being a little bit older with an average finish out, usually average rents. And then Class C being the lowest class in office space. These are much older, have the lowest type of finish out, usually outdated architecture, command the lowest rents, usually in the least desirable areas of town. It's worthy of note you can use what's called the value add strategy, which I'll mention in another video later on, to reposition one of these assets. So you go in, you remodel or rehab the place, and then you can bump it up a class level. And that's done a lot in office. The other thing I'll mention, this class system is also used in apartment spaces, but the difference with apartments is you can go down to from Class A all the way down to Class D, and Class D is what they call war zone. You're in a super high crime area. The other type of office space, which I didn't mention earlier, is medical office space. So those are either hospitals or a collection of medical buildings that are, specially purposed for medical use. Office space usually has a little bit longer leases in them. Usually tenants sign up for a 3 to 5 year lease, and those leases are based on a price per square foot, usually what's called a triple net lease, which again I'll explain in another video. Office is generally seen as one of the riskier types of asset classes in commercial real estate. The reason being, when the economy sours and companies either start to cut back on hiring, or they cut back on their workforce, or go out of business, in general, they cut back drastically on the amount of office space that they need. So you can see cities with a glut of open office space in them when the economy is not doing well. The sixth category in commercial real estate is self-storage, something that I'm very familiar with. Self-storage usually isn't included in most people's categories of commercial real estate, and I think it should be, simply because of the sheer number of self-storage facilities in the United States. There's over 52,000 facilities in the U.S., And that's total facilities, not just units. That's more than the total number of McDonald's, KFC's, and Starbucks restaurants combined. So I think it warrants its own category. Self-storage is largely seen as a great recession-resistant investment. It also has done well here over the last several years during our bull market. So it's a good investment in either type of economy. Our seventh and final category in commercial real estate is special purpose. Special purpose encompasses churches, community centers, amusement parks, and basically any other type of real estate that doesn't fit within the 6 buckets that I mentioned earlier. So there you have it, the 7 different categories in commercial real estate. We'll have part 2 of this 3-part series in investing in commercial real estate coming out later this week, so be on the lookout for that. Thanks for watching.